Hi, and welcome back to our Bollinger Band Essentials training. We're getting into class number 4, which means we're going to start talking about pulling everything together into the actual plays that we use with our Bollinger Band. So there's 3 specific plays. We've already talked about them. We've got the squeeze, we've got the trend trade, and the reversal play. We're going to look at those here, and then we'll do a quick wrap up. And by the time we're done with this, you're going to have a pretty good idea of how to start trading with Bollinger Bands. So let's take a look at the first one here. Play number 1, which is the squeeze play. Now, the squeeze play is going to be the most popular strategy. This is the one that typically most people look for. This is the one that most people are very familiar with and have a good association with it. The idea of the squeeze play is it looks to get into a trend early on in the trend. That's one of the reasons it's so profitable. When you see those bands contracting, you see that squeeze coming into place, and then that expansion comes in, that new trend is taking hold, you're getting into that trend early on. That's right before the most explosive part of the move. That's why so many people like the squeeze play. One of the things about the squeeze play that you need to know is it anticipates high volatility. What do we mean by that? It's lots of price movement. High volatility means that the price has been contracted, it's not doing a whole lot, and then suddenly, boom, it takes off and it's really doing a lot. Now, that volatility could be bullish volatility, it could be bearish volatility, but the idea here is that the price of the stock is moving a lot, it's moving very quickly. And especially if you're an options trader, that's exactly what you want. Unless you're selling options, pretty much the only way to make money in the market is to buy something and then have the stock move, or to short it and have it move. They're mostly trend trades that we use in the market. And so volatility becomes a real important component of recognizing when those opportunities are going to be showing up. The squeeze play helps to show that, again, because it's anticipating that new trend, shows that contracted volatility, and then it's anticipating that explosive move that's about to take place there. So it's an anticipation of high volatility with high price movement, and usually this portends a new trend, meaning it's the beginning of something new. Now, there's one important bullet point here, and I'm going to underline it in a couple of different ways here. Beware of the head fake. This is the most important thing to recognize. The squeeze play is a great trade setup. It is a wonderful trade setup. And if it were not for the reality that head fakes happen, the squeeze play would be the perfect trade setup. We would never need any other trade setup. But here's the reality. The reality is the squeeze play sets up, and sometimes it does a head fake. And when it does a head fake, if you're not paying attention, you're not prepared for that, you're not aware that this could happen, those are going to be the ones that will really take a toll on your trading account. So be aware of the head fake. We're going to look at it here in just a minute, but be aware of it. This is the Achilles heel of this particular trading strategy. Now, let's talk about some things to remember here. First thing you need to remember, the squeeze itself is the setup. It's the breakout is what you're looking for, is the trigger. A lot of people think when they see the squeeze, you see the squeeze in here? A lot of people think that when that squeeze happens, that they should go ahead and get into a trade. That is not true. What you've got to wait for is you've got to wait for the actual breakout itself. That's going to be the entry for the trade. Now, in this particular one that you see on the screen here, this is actually a head fake. You can see how this worked out here. It broke initially to the downside and immediately turned right around. That's the head fake. And so this would be the bearish entry. And then we immediately get out of the trade, we take on the bullish trade, and then if you were not already in the trade from having recognized the head fake, then you get in up here at the top of the band. That becomes the entry. But it's very important to remember the squeeze itself is just kind of the hey, there's a trade about to happen. It's an alert. It's a trade setup. It's the breakout that is actually the trigger for the trade. You've got to remember that. Otherwise, you'll be jumping into trades, and you don't necessarily know which way you're going. That's another thing you got to remember. These trades can break either way. When you see a squeeze play, it could break bullish, it could break bearish, it could happen either way. So you've got to remember the squeeze can break either way. You can't be biased. Okay, let's talk about some rules that you need to be looking for. The first thing you need to be looking for is a tight bands. You need to be looking for that opportunity when the Bollinger Bands have contracted. Now, sometimes there's question about how you measure the tightness of those bands. And the easiest way you can do it is to use that indicator we looked at a couple of classes ago called the bandwidth indicator. When you pull up that bandwidth indicator on your chart, you can see visually depicted relative to other moves how tight these bands are. And so here's a good rule of thumb. Use the lowest bandwidth reading of the last 6 months. Now, this is not a perfect rule of thumb, but if you go back and you look at the last 6 months, or maybe it's the last 4 months, you can play with this a little bit, kind of customize it to the stocks you're trading or the currencies or whatever it is you're trading and your own trading style. Maybe if you're on a day trading scenario, you may not certainly want to go back 6 months. You may go back the last 6 days or something. But the key here is that you go back and you look and you say, where is the lowest bandwidths? And that's what you're looking for. You're looking to match the lowest bandwidths over a decent sized look back period. If it's a constant squeeze, then it's not the lowest bandwidth. Sometimes you'll see stocks that are just in a really nice trend or really nice channel, and you kind of have a stable bandwidth. And people often think, well, that's a squeeze, and it's really not a squeeze at all because the stock is kind of stuck there and it's maybe been going in that range for quite some time. You're looking for the outlier. You're looking for the time when the bandwidth has really come to one of its lowest readings in the last look back period. If you're on a daily chart, again, a 6 months is kind of a good window to look back and see what those settings are. Enter the breakout after the first closing price outside the band. This is your first rule right here, your first real entry rule. Enter on the first closing price outside the bands. In other words, once the candlesticks close outside the bands, that is actually a signal of strength. One of the big misunderstandings about Bollinger Bands, people often think the top of the band is a sell signal, the bottom of the band is a buy signal. That's not always true. In fact, of these 3 plays we're going to look at today, only one of these plays is going to fall into that category. 2 of these are actually looking for pushes outside the band to signal strength. In the case of a bullish band, the upper band, it's a bullish strength. In the case of the lower band, it's bearish weakness or strength for a bearish trade. But the idea here is just because you're at the upper or the lower band, in and of itself, that does not mean that the trade needs to reverse or needs to go to the other direction here. And so with the squeeze play in particular, you're looking for, on a bullish trade here, you're looking for that first close outside the band, and then you're going to enter on that. Once it's closed, you can jump back into that trade the next day. You could get in on the first day of real strength in the direction of the trade the day after that, or whichever day that happens. A couple of ways you can write your own rules to get into it, but the signal here, the trigger, is the first close outside the band. And then once that happens, the trade is on. And then you want to turn around and set a stop. Now, I encourage you, especially with a system that is as quantitative as the Bollinger Bands, I encourage you to set something like a parabolic stop. It's going to be very specific. It doesn't require that you learn to use buffers. It doesn't require that you learn to identify support and resistance or set, based on swings or anything. You can just simply put the parabolic on your chart and track with that. Wherever the parabolic says to set the stop there, trust it. Every day or two, you need to come back and adjust it. Every day, the parabolic will adjust, but you're probably going to have to set your actual broker's settings there. You're going to have to tell them where you want your stop every day, but I really encourage you to use a system like the parabolics for a trade setup like this one right here. Now let's make some observations. Occasionally there's not a closing price outside the bands. Sometimes what happens is the trade gets set up, you have the squeeze, and it starts moving, but it never closes outside the bands. And if you looked at those rules we just looked at, the first rule of entry is to enter after it closes outside the band. Well, what if it never closes outside the band, but the trade starts to expand? Well, here's the way you handle that. Watch for 2 successive days of band expansion and then enter. If you see 2 days back to back, or 2 sessions if you're in an intraday session here, 2 sessions back to back, and the bands are expanding, but you're not outside the band, it's okay. You can go ahead and enter the trade as a squeeze breakout, and just don't expect for the bands or for the price, I should say, to close outside the bands. This happens, it happens relatively frequently. So the key here is wait for 2 days of band expansion and then get into the trade. The tighter the squeeze, another observation here, the tighter the squeeze, usually the more explosive the move. This is not a hard and fast rule, but more often than not, the tighter the squeeze, the bigger the explosive move after it finally breaks out. So those are some interesting observations for you. So let's talk about the head fake. The head fake is the only thing that makes this squeeze play, or I should say keeps the squeeze play from being the perfect trade. Otherwise, everybody would just follow the squeeze play. It's just a perfect trade setup. But the head fake happens. And so here's the important thing, is that we learn to identify it. So here's what we're going to look for here. We're going to look for candlestick reversal patterns within 2 to 4 days, or if you're in an intraday chart, 2 to 4 sessions of the squeeze breakout. As soon as it starts to break, if within 2 to 4 candlestick sessions you start to see a candlestick reversal, for example, morning star reversal, evening star reversal, bullish engulfing, bearish engulfing, harami patterns, anything that starts to tell you, shoot, this trade's reversing, flip your direction. Go the opposite direction here. If you see them, reverse your position. That's why we went over them in class number 3, where we talked about all those candlestick patterns. You got to learn to identify them and recognize them. Even if you don't know the name, understand what they're telling you, because those are your reversal signals. They're really, really powerful with your Bollinger Bands. So when you see them, reverse your position. If you've gotten into a bullish trade, if the squeeze broke bullish, you're going to go into a bearish trade. If the squeeze broke bearish, you're going to go into a bullish trade. Flip your position. Your first target is going to be the opposite side of the bands. So again, let's say you broke into a bullish trade and it starts to have the head fake reversal. You flip your position. Your first target's the lower band. If you broke into a bearish trade, you have the reversal, you flip your position, your first target's the upper band. That's going to be your first target. Now I say it's the first target because there may be more. Oftentimes what happens is the trend will form in the opposite direction of the initial break. So let's say it started to break bearish, gives you the head fake, it'll trade right back to the upper band, and oftentimes will continue with a bullish trade. So the upper band would be your first target, but maybe not your ultimate target if the trend starts to continue. What I want to do here is let's look at several examples, then we'll do some back trading.